If you're trading multiple LEAP option contracts on any specific vehicle, but things just are not working out, or sometimes those trades just go sour on you, there might be a better alternative to trading those LEAPs, especially if you're doing multiple contracts. And what I want to chat with you about today is about staggering those LEAP option contracts in different days, different strikes, in order to create a better, call it risk profile picture behind those LEAPs. Now, if you don't know me, I'm Sasha, the options coach, and I've been teaching people to trade options over the last decade. And one of the latest things we covered in our class was the Atomics LEAPS class, talking about how to stagger some of those LEAP contracts in different spots in different zones, because LEAPs or just options behave differently in different expirations. So if you'd like more information about this class, just shoot me a message down below. You can write a comment as well. We can reach out to you. But if you're on YouTube as well, I think the better alternative is just go to our website and then grab some more information or book a quick call. Anyways, when we go into LEAPS, one of the things you have to look at is just, in fact, just trading overall an option contract. When it comes to risk profile pictures, is that certain LEAPs, or even if you're just, let's say, buying an option contract, you have a risk profile picture. And what these do is they give you an idea of how things move and behave and react. And when you have this view of a contract, what some people will do is they will buy their contract, like let's say this is our buy spot. They'll buy it right here, but there's an acceleration point that has to happen in those LEAPs. So for example, you're picking up some speed. Really, it comes down to this delta. You're picking up some speed, faster, faster, faster. And then over here, you might be more like at an 80 delta or so, which means now as the stock price is moving in your favor, you're making more and more money. However, at the beginning, at this slow process point, the acceleration is very slow. And in fact, if we redraw that picture and we go even further, so let's say we have a risk profile picture that looks more like this, where the acceleration is very slow and then it picks up speed and you're over here. Well, what happens is that if you're buying something, let's say a 10 delta and a cheap LEAP, you have a long process. It's not to say that you're not making money when the stock is moving in your favor, but it takes a while for it to pick up speed. Think of this as accelerating with a lot of weight behind you if you're trying to drive a pickup vehicle or tow anything. It takes a bit of time to accelerate that and then finally get moving. Now, once you're moving, you're fine, you're good, but it takes time to do that. So whereas if you go kind of more in a sweeter spot right here, let's just call it a delta of maybe 30 in this case, or even 40. What's going to happen is it's going to pick up some more pace a lot faster. Now, over at this spot, delta 50, yeah, you're moving and grooving, but you are more expensive on your option contracts. So if you're dealing with multiple option contracts beyond that, what some people do is they'll go, let's say this is 380 days out, they will stack all these option contracts, and they might pick one of these spots, like let's say it's over here or over here, it doesn't matter, take your spot, but they will stack all, let's say 3 contracts in one spot and area. And what that's doing is that the 380 day versus let's say a 450 day or 180 day, they react differently in different spots and different zones, which means you're going to have a different amount of acceleration. So I want to show you this picture that if we go in on Microsoft and we go to something about 360 days out and we buy an option contract, I'm going to go to about a 50 delta here. And what you'll find is this acceleration on Microsoft with a 50 delta, it's going to start picking up speed very quickly. But if I go into, let's say over here or over here or over here, it takes time for that to accelerate and then pick up more pace later. So I could go into this 50 delta, but what if I go in and do something that's instead of the 420 here, let's go into about a 450. Okay, now look at this delta now, it's at 38. So what you'll see here is that this acceleration curve is a bit slower and then it picks up speed. And then if I go over to a 500, now we've got a much cheaper option, but look at this, how fast it picks up pace. It's really slow, and then it picks up that speed. So when you start doing these things, just staggering in different spots, all of a sudden gives you some flexibility. The option contracts that are further out right here are much cheaper. See, this one's only $1,000. This one's $2,000. This one's about $3,000. Now, the cheaper ones, they are cheap for a reason. Yes, they're cheaper. They're less likely to kind of call it win. But the good news is because they're cheaper, you can actually make a greater return on them, but they're slow to accelerate, right? They're much slower to accelerate, but they can haul a big load later if all things work out. The ones that are more expensive, let's say this $3,000 one, it picks up speed immediately, reacts faster, but it's more expensive. So there's this trade-off effect where, hey, sometimes you do want some of the cheaper ones because you might want a bigger percentage of return or get some of those cheap items in order to maybe accelerate the profits. So this way you don't have to spend a lot of money. And other times you might want the expensive ones. And this is where now staggering these different strikes at different expirations or zones kind of comes into place, because I could go into also, instead of doing this cheaper one right here, I could take this one maybe even to June instead of March. And yes, now it's a little more pricey. And this one over here, I could also take to, instead of June, I could even go to December. So that's much more expensive than even the other one, but I've got more time. You see, if you don't spread your time, because right now I've got a March, a June, and a December. And if we start spreading this out and looking at this zone, okay, what we've got here, we'll take a quick screenshot of these option contracts, and we'll pull it in right here. Okay, so when you have something like this and we have these different expirations, what you'll typically find is that certain expirations, when you go into, let's call it this 363 or 453, or so these different days till expiration, by having those different days, the reason people are getting a leap is they're going for a leap because they are looking for that stock to accelerate and appreciate for a longer period of time. However, that longer period of time, it could be in the next year, or it could be in the next almost 2 years later. If that's the case, what if it happens in 1.5 years? So 1 point, even a quarter years, or somewhere in between. If you concentrate your risk all in the 360-day options, let's say I got 5 contracts over here. Well, what if the stock stays stable? What if we had a down market? Now you've put all that risk in that one spot, whereas instead you could have put one contract in this spot, one contract in here, and one contract in here, or a couple of contracts in different spots. And now you would have a variation to these contracts that if things do go down and if things do have a problem, then at least you'd be more isolated on the risk. So let's say, for example, we'll go here and let's erase that. Let's say, for example, this 363-day actually turns out to be a full loss, but as long as you have these other ones, you could actually have maybe a winner or a winner over here, simply because it didn't make it far enough in those contracts, but the other ones it did. So between the 3 trades over the course of this almost 2-year time horizon, you at the end are a winner, but maybe that first year you were not a winner. So that's what I want you to think about when you're looking at contracts and looking at these leaps. Look at staggering those positions, not only staggering in terms of expiration, but staggering in terms of the strikes that you do, and also putting them on different dates. This is exactly some of the concepts we covered here in the Atomic Leaps class. So by all means, feel free to reach out if you have questions about some of the classes that we do. You can reach out to me on Messenger or check out our website as well. Anyways, truly appreciate you joining me. Thank you so much. Hope you got a lot out of this video, and I will see you on the next one. Take care.